This is Randy Finney with the Right Side of the Chart, and today is Thursday, June 30th, 2016. I wanted to do a quick market update, go over some of the levels to watch, some of the developments that have happened over the last couple of days, and really share my thoughts. And the takeaway from this video is nothing much has changed in the last couple of days. We've had an impressive rally. There's, for those who are long or happen to go long here, congratulations. For those who are short, nobody likes to see the market go up 5% or so, whatever it did in the last few days. But bigger picture, if you take a look, and I don't have all my trend lines on this particular chart we're looking at here, but just look at the last couple of years, and this is the norm. And more importantly, as impressive as the rally was, here we'll measure it out here. Last few days we gained, and this is the NASDAQ 100. Up, which was one of the stronger indexes, up 5.6%. All right, well, what happened in just 3 days before that? We dropped 6.44%. So as bullish as that was, it took 4 days and we still haven't even taken away or erased the losses over the previous 3 days leading up to that. So that is not a victory by any means. And more importantly, again, it doesn't change anything in the longer term outlook, or even the intermediate term outlook, in my opinion. So I just wanted to point that out. And also, as we go back in the chart here, let's go back in time. You look at other periods where we've had very comparable drops in the market. Here was a little over 5% drop in the NDX. And then what do you see? Just like the last few days, we see an almost equal answer to that drop right there. Fell just shy, as so far of where we started. We're still well below these reaction highs back here earlier in the month, right up there. So, we drop, we go up, we go down, we go up, we go down. This market has been plagued with this, and until you break out of these ranges, finally this one, boom, it led to that. And you can go back in time. Here's another comparable drop. Move up that almost equaled that high, fell right back down the next day. So point is, keep your emotions in check during times like this. Unless there's a true breakout, you see a break of a major support or resistance level or a trend line that you're watching, key moving averages, something changes. But just like back here, this was chop and slop, and these ranges were just as big back here. You can see these rips and dips, and there was a period where it went on for several weeks, a month or so. It happened again here. And yeah, at this point, the market was trending higher. But finally, the divergences played out as they so often do. Negative divergences, as you can see down here on the RSI and the MACD. And these divergences, you get complacency and extreme bullishness, especially that ramp. See that last final, that's typical. Look at that gap. I remember we had something very similar. If you go back and pull a daily chart, go back during the flash crash in 2010. I remember a very similar price action leading up to before that flash crash. It's just, my interpretation is just the final squeeze out of the shorts. And once they clear out the shorts, whether they being the institutions, the smart money with the power to do that in the capital, it doesn't matter. That's the net effect is boom. And then we came back up. So it's just been a tough market. Let's not get too lost up into that. More importantly, why is this happening? Why is this volatility? Why did we have such big days in the last few days and such a big drop leading up to that? Well, it's simply a function of the VIX. The VIX, here's the VIX chart. I've put this up several times recently. We had prices in the VIX, and I had highlighted we're at this S1 level. I had support 1 level for months. We were trading, bouncing on that level in this range. I'll shade it in for you. I'm sure you can see it, but you see we had this range right here. And at this point, right here where I'm holding the that little pencil drawing tool, we punched down, made a divergent low. You can see the positive divergence here on the MACD and the RSI, and then boom, we went up. I had the top of that resistance zone was 1755. We gapped above it, went up. I had this as my initial target zone, pulled back tested that level from below, shot back up above it. All I'm trying to say is the VIX is elevated now, and yes, it's fallen quite a bit in the rally in the last few days, but we've only come back to the top of that zone. We're just a little bit below that 1632 level. See, we closed here at 1563. But for the most part, we're still right around the top of that zone. So you need to be on your toes. And just as we've had these 1 plus 2% gains over the last couple of days, we can just as easily have a 2 or 3% down day tomorrow or anytime on Monday, anytime next week, until and unless, and of course there's never any guarantees, we can always have one of those, but until and unless the VIX comes back down and to its normal range, or even this longer term support level here, that's when volatility subsides, and that's when you start to see these more moderate candlesticks. I'm trying to change symbols here. That's trading like this when price swings aren't so much. All right, let me look at let me try to keep this video short. Let's just look at some developments that might help us in the near term here. I posted these in the trading room, some 5-minute patterns. This is the SPY on a 5-minute time frame. Pretty well defined uptrend line, forms this bearish rising wedge pattern here. Each of these lines are support or resistance. Any lines above what we're right at, we closed at that gap there. So these are all potential downside targets, i.e. support levels. And what I'm looking at here is the SPY on this 5-minute time frame has put in a divergent high. Now this may, if it does play out, which my expectation it will, I was expecting or hoping to see a little breakdown in the close to get that started. We didn't get that. So if it's going to play out, just looking at where these patterns are, we're so close to the apex, this thing's going to need to play out tomorrow, like stat, probably on a gap down in the morning. We'll see. I thought we'd get a gap down today, and we didn't. We got a gap up and a run. So, but I would say with a pretty good degree of confidence, looking at these charts, that negative divergence on the RSI, the MACD, that pretty well defined uptrend line. Nothing great, but pretty decent. And you look at the trend indicator right here. I talk about this often, the signal line or 9 EMA on the MACD, regardless of what time frame you're using. In this case, it's a 5-minute time frame. This works just as well on a 60-minute, a daily, weekly chart, in which case I use the PPO, which is very similar to the MACD, but I also use the PPO's 9 EMA. And you can see here, when the 9 EMA, that white line is above the 0 level, the trend is bullish. When it crosses below, as it did here, I'll put the crosshairs on it, the trend changes to bearish, and you had this move down. The trend remained bearish until we crossed over here, in which case it has been bullish since. So this is technical analysis. These are different things lining up. We have a rising wedge. It shows a contraction in the range in prices. We have divergence that confirms that wedge. We have a MACD, which is a momentum indicator, making a lower low. That's the divergence. Also pointing lower, so that tells me there's a good shot we're going to cross over. And we'll have, if that's the case, tomorrow we'll have two sell signals. We'll have this 9 EMA cross below the 0 line, and we'll have prices break down below the wedge. We have similar patterns in the Qs. The Qs I had a little bit different. I have an uptrend line that goes like this. We had a breakdown, a back test, and prices moving a little higher. And I use this as the divergence line. You can see prices moving higher against the MACD and the RSI making lower highs. Same story. It's MACD's pointing lower. I'm waiting for a cross below the 0 line and prices to roll over. These are some potential targets on the Q, or Qs I should say. There's IWM, 5-minute bearish rising wedge pattern, a little bit of an overshoot at the top. We had just a little ramp into the close on IWM. Some securities are starting to look to me like, as I went through the IWM, I don't have time to do it in this video, I want to keep it short, but I'm seeing a lot of the top components, what appear to be blow-off tops or short squeezes, like that ramp I just talked about a little earlier on the Qs, that similar to what was led up into the flash crash. Not exactly, but either way, some unnatural price action in some of those small caps. So just as I was stating a few weeks back when I was scaling in short, after the failures here, let's go back. I mentioned that the IWM was one of my favorites. I thought it had the most meat on the bone. You know, when getting short, especially after this breakdown here, and it did. It had a healthy drop. It's already dropped 8% since the breakdown of that wedge. Retraced a lot today, but we're back to a pretty significant resistance level. Even here on the daily chart, you can see it. There's a gap. There's that reaction high here, reaction highs here. So this level, call it 115. I don't need to. There it is. We're right about 115. Pretty significant resistance on IWM, so we'll see what happens. Let's take a look at the 60-minute charts. There's a resistance level. I think I have some fibs. Yeah, I do. Where this is a fib cluster. See these lines right here? These are Fibonacci retracements off these reaction highs. And when you go to different important levels, like a reaction high is an important level. So we had that reaction high there, that reaction high. I put up Fibonacci's. I put them different colors so you could see them. There's a 61.8 and the 78.6 fib, which is right where we closed today. And that last minute ramp into the close today, we really were at the 61.8 of the bigger move down, and there was some short covering into the close, and that ramped us up there. So either way, this is what we call a Fibonacci cluster when you have two key Fibonacci levels in close proximity. So that's also resistance. Let's look at a couple other 60-minute charts. There's a SPY from the entire move down, or when I say the entire move, I'm referring to the June highs, June 8th, into the lows. We closed right at that 78.6 Fibonacci retracement level. And let's take a look at some price action here. There's a potential downtrend line coming into play. I say potential. It has a couple reactions. It's not really. The more reactions you have, the more valid the trend line. But either way, something to note. And you can also see that 78.6 fib there. And let's look at the Qs. There's a fib cluster as well. Let's see if I have it on another board that's a little more clear for you. Yep, there it is. 61, what are these? Yeah, they're both the 61.8 fibs off this move here. Where did I put that other line? Hold on one second. Okay, I had to go back, change the time frame to go a little farther back. That was actually a fib I had left a long time ago. There was a reaction here back in December, the December 15th, early December. So that drawn down to the lows at that point, that actually carries over, and it's interesting because we have a fib cluster. So that line, which now we'll lose those levels as I zoom in a little bit here, but you can see there's two 61.8 fibs. That's a bigger Fibonacci retracement. And then this more recent move down from the highs. These are the levels I was looking at on those other charts, the early June highs earlier this month. And let's, for kicks and giggles, put one up here. And it wouldn't surprise me if we had another fib come in at this level. Oops, what I need to do is go... Yeah, this is a line I'm adding now. It should be very similar because it's not much different in price there. We'll have to put a different color, and let's just see if we come up with one of the major fib levels. Yep, sure enough. Yeah, bunch of fibs there. So could be a stopping point for the Qs. We'll see. Again, let's see if those 5-minute charts play out, and we'll go from there. Okay, I'll wrap it up here. We'll just zoom out. Take 2 seconds to do this. This was the daily chart I started with, showing the back test of the Russell 2000. I'm putting a lot of focus in this right now, as well as the Qs. And then bigger picture, remember, the bigger picture remains this, we're in this grinding type range. Here, we can just show you. The markets, like I said, the Russell has clearly been in a bear market with it's dropped, what it was, over 30% or something, I said already. But this has been a frustrating time for bulls and bears alike for the last couple of years, as the market is been in this, whether it's a topping pattern that will break to the downside, as I expect that, or suspect that it will, and expect, I should say both, or as the bulls think it's just a big consolidation and some super bull that's going to continue. We're already long into the tooth in this one, but anything's possible. But if we take it from an even more simplistic view, go back in time, let's look at a long-term chart. It goes back to the early 90s. This is the Russell 2000 on that index. We have like always, we have bull markets, and bull markets are often defined by uptrend lines, as we have here. We have an uptrend line, a breakdown, a backtest, and a bear market. It may not look like much, but from peak to trough, let me try to grab that, get that line out of there. Peak to trough, that was a healthy drop of about 47%. Here's the bear market back in 2007 to 2009, and that one dropped 59%. And now let's just look at a few similarities and things that I want to point out. We'll wrap it up. Okay, so you have a bull market, and these bull markets typically run 5-6 years on average. You break down, backtest, and bear market. Then when you have a new bull market, it's defined by an uptrend line. Breakdown, backtest, you can see 3 or 4 monthly candlesticks, and then the bear market. New bull market, breakdown, backtest, and now look at the similarities. What I want to point out here is look at the similarities between now and the beginning of the last bear market. We had both the primary uptrend lines. We had a breakdown and a backtest, as I just highlighted there. I'll get rid of these. Breakdown and a backtest. We had the initial thrust, pretty impulsive thrust down, and then we had a period, and remember, these are monthly candlesticks, so this went on for months, where the markets rallied, retraced a good deal of that. And what's also interesting to note is check out, I have this 2017 EMA pairs. These are monthly, the 20 and 17 moving average. I believe these are SMAs, simple moving averages, if I'm not mistaken, on the monthly time frame. They do a really good job of defining bull markets. You can see it there once the bull market broke, and that was a bear market there. This was a bear market within a larger bull market. You can see here as I do the measuring tool, that was a 38, almost a 40% drop. So this wasn't any type of whipsaw signal. This was more of a secular bull or bigger bull market and a bear market within there. And once that bear market was over, we got back above those moving averages. And after the trend line break and back test, we fell back below. We were below through most of the bear market and then crossed back above. And these moving averages did a great job of defining the bull market. After the trend line break and back test, they fell back below. And as we zoom in here, you can see, look how perfect. We came and back tested it. Fell back down, back tested again, took a few months, finally rolled over. That was it, all she wrote. So point being, the Russell stayed below those moving averages for the bulk of the bear market, came back up, and that started a new bull market. And as with whether using trend lines or horizontal levels or moving averages, when tested from above, they often act as support. And when tested from below, they often act as resistance, as I just pointed out here. So now we're in a new bull market. We come back, we back test those. Successful, those support levels hold, we bounce. Then we have what you might consider a whipsaw signal, but wrong. We had actually a nice bear market. Most people don't realize we had a bear market in the Russell 2000 in 2011, as well as the NASDAQ Composite, a lot of indices. The SPY, a couple large cap indices managed to just avoid that bear market designation, but as you can see, if you look at the box, right towards the bottom of the box, it pops up to the left. In the red letters, that's a 30.5% drop. So a drop of over 30%. So I just want to point out this wasn't a whipsaw signal. It indicated that the trend was down, and once we came back up, you can see it did a good job and has remained above monthly candlesticks. So all that matters are monthly closes. Look at the lower of the two lines if you have two. In this case, we're using two trend lines. And then finally, look what happened. We broke down, broke below the uptrend line, the primary bull market uptrend line, and we broke at the same time. We broke down below those 17 and 20 moving averages, tested them, fell, tested them. So again, if you ask me where we are, history doesn't always repeat itself, but that's what technical analysis is about: identifying past patterns, price action, different things in the market. You have trend indicators down here like the ROC 13 that does a good job of defining primary uptrends and downtrend, trends bullish, trends bearish. So for the most part, these are bear and bull markets. I don't know what else to say. To me, the picture is, the longer term picture is bearish, and that's why during these rips like today, I view them as not buying opportunities, but more of a shorting opportunity to short the rips into resistance. And until and unless the bigger picture changes, then that'll remain my bias. But of course, as most of you know, there's been plenty of times throughout the years, including this year alone, where we've had some great shorting ops, but we've also had some great long ops, and we've had many trade ideas and on the long side, and they've been very profitable. I just don't see right now an objective time to really add any long exposure. There's just too much resistance overhead, and the longer term charts are just still pointing to the fact that we're likely going to see more downside in the coming months. Okay, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.